What if the next great shift in wealth has already begun, and almost nobody realizes it? Not because the evidence is hidden. Not because the information is secret. But because history has taught us that the biggest financial turning points rarely announce themselves with breaking news. They begin quietly. A central bank changes its strategy. Government debt reaches levels few imagine possible. Confidence starts shifting beneath the surface. And while millions of investors continue watching stock prices, chasing headlines, and reacting to every market swing, the world's largest financial institutions are often focused on something entirely different. History shows that by the time the public recognizes a major monetary shift, the opportunity to prepare may already be fading. So here's the question that deserves every investor's attention. Are we witnessing another one of those moments today? In this documentary, we'll examine the evidence, not the hype. We'll explore why gold continues to capture the attention of central banks, why monetary confidence may be entering a new chapter, and why former Federal Reserve Governor Kevin Warsh has repeatedly emphasized that credibility, not predictions, is one of the most valuable assets any financial system can possess. Because this isn't just another discussion about the price of gold. It's about understanding the quiet signals that have preceded nearly every major financial transition in modern history, and whether those signals are beginning to appear once again. Every major financial transition in modern history has shared one remarkable characteristic. It looked ordinary while it was happening. When historians look back at the collapse of the Bretton Woods system, the inflation crisis of the 1970s, the global financial crisis of 2008, or the unprecedented economic response to the pandemic, they often identify clear warning signs that seem obvious in hindsight. But for the people living through those moments, the picture was anything but clear. Most investors believed the economy would return to normal. Most policymakers believed the challenges were temporary. And most financial headlines focused on what had already happened instead of asking what was quietly changing beneath the surface. That pattern raises an important question. Could we be living through another one of those transitions today? Over the last several years, the global financial landscape has changed more rapidly than many people realize. Inflation surged to levels that hadn't been experienced in decades. Central banks responded with one of the fastest interest rate tightening cycles in modern history. Government debt continued climbing to record levels, while geopolitical tensions reshaped trade relationships, energy markets, and global supply chains. Individually, none of these developments seem extraordinary. Economies have experienced inflation before. Interest rates have risen before. Governments have carried debt before. But history rarely changes because of one event. It changes when several long-term forces begin moving in the same direction. That's exactly what makes today's environment so fascinating. Many investors continue asking a simple question. Where will gold trade next month? Yet some of the world's largest financial institutions appear to be asking a completely different question. How should we prepare if the monetary landscape continues evolving over the next decade? That difference in perspective may explain why gold continues attracting attention even during periods when markets appear relatively stable. Contrary to popular belief, gold has never been solely about chasing higher prices. For centuries, its role has been tied to something much deeper. Confidence. Confidence in currencies. Confidence in governments. Confidence in monetary systems. Whenever confidence becomes uncertain, investors naturally begin searching for assets that have historically preserved purchasing power across changing economic environments. That doesn't mean gold always rises. It doesn't. Like every financial asset, gold experiences periods of strength, weakness, volatility, and consolidation. But unlike many investments, gold has remained relevant through monarchies, industrial revolutions, world wars, financial crises, technological revolutions, and the rise of modern digital economies. Very few assets can make that claim. Perhaps that's why central banks still hold significant gold reserves despite extraordinary advances in financial technology. Perhaps that's why experienced investors continue watching gold even when headlines focus on stocks, artificial intelligence, or cryptocurrency. And perhaps that's why the conversation surrounding gold has become increasingly important in today's uncertain world. Because the real story isn't simply about whether gold reaches a new price target. The real story is about understanding why confidence itself may be entering a new chapter. Markets rarely change overnight. They evolve gradually. A policy decision here. A shift in reserve management there. A change in investor psychology that almost nobody notices until years later. Then suddenly, everyone realizes the world has changed. The biggest financial transitions don't begin with panic. They begin with quiet decisions made long before the headlines catch up. And that brings us to the next piece of this story. Because if confidence is quietly becoming one of the world's most valuable financial assets once again, we first need to understand why some of the people responsible for protecting that confidence have become increasingly focused on credibility, discipline, and long-term monetary stability. That is where our story truly begins. What is the one factor capable of changing an entire financial system without most people realizing it's happening? The answer isn't inflation. It isn't interest rates. It isn't even gold. It's confidence. Confidence is the invisible force that keeps every modern economy functioning. It's the reason people trust the money in their bank accounts. It's why businesses invest billions of dollars into future growth. It's why governments can issue debt, consumers can borrow, and financial markets can continue operating even during periods of uncertainty. The moment confidence begins to weaken, everything else starts changing. And history has shown that confidence rarely disappears overnight. It fades gradually, almost silently. Think back to the global financial crisis of 2008. The crisis didn't begin the day major financial institutions collapsed. Those dramatic moments were simply the result of problems that had been building beneath the surface for years. Excessive borrowing, rising leverage, and growing financial imbalances slowly eroded confidence long before the world recognized the danger. When trust finally broke, markets reacted with extraordinary speed. Banks stopped lending. Credit markets froze. Investors rushed towards safety. Governments and central banks were forced to take unprecedented action simply to restore confidence in the financial system. That period left behind one lesson many experienced investors never forgot. Financial systems survive because people believe they will survive. Former Federal Reserve Governor Kevin Warsh has repeatedly emphasized that monetary policy is about far more than setting interest rates. At its core, monetary policy is about preserving credibility. Because once credibility begins to weaken, rebuilding public confidence becomes one of the most difficult challenges policymakers can face. That idea may sound abstract, but its effects are visible throughout history. When investors believe inflation will remain under control, they make decisions differently. When they trust the long-term stability of a currency, capital continues flowing into productive investments. When confidence in institutions remains strong, markets often recover even after periods of significant volatility. But uncertainty changes behavior. Instead of asking how much money they can make, investors begin asking how much wealth they can protect. That shift in psychology has shaped nearly every major financial transition of the last century. Perhaps that's why gold has remained relevant despite enormous advances in modern finance. Gold doesn't generate earnings. It doesn't pay dividends. It doesn't create cash flow. Unlike paper currencies, gold isn't created by monetary policy. Its value has historically been linked to scarcity, durability, and the confidence people place in it during periods of economic uncertainty. Far from it. There have been many years when stocks, businesses, and productive investments delivered significantly stronger returns. But gold has rarely been viewed as a tool for chasing extraordinary gains. And perhaps that's the real story unfolding today. The conversation isn't simply about whether gold rises or falls next month. The conversation is about how investors, institutions, and policymakers are responding to a world where inflation, government debt, geopolitical competition, and long-term monetary stability are all becoming increasingly important at the same time. Because once confidence begins evolving, markets eventually evolve with it. And if confidence is the foundation of every financial system, then the next question becomes even more fascinating. What are the institutions responsible for protecting that confidence quietly doing behind the scenes, long before the rest of the world notices? If confidence is the foundation of every financial system, then one question deserves far more attention than it receives. What are the world's central banks doing while everyone else is watching stock prices? The answer may surprise you. Unlike retail investors, central banks don't invest with next quarter in mind. They aren't trying to outperform an index, beat inflation over the next 12 months, or capitalize on short-term market momentum. Their responsibility is far greater. They manage national reserves, protect financial stability, and prepare for economic conditions that may not emerge for years. That difference changes everything. While financial media often focuses on interest rate decisions and daily market volatility, central banks are asking much bigger questions. What happens if inflation proves more persistent than expected? What happens if geopolitical tensions continue reshaping global trade? What happens if confidence in reserve currencies gradually evolves over the next decade? These aren't questions with simple answers. That's precisely why preparation matters. Throughout history, central banks have consistently adjusted their reserve strategies whenever the global financial landscape entered a period of transition. Sometimes the catalyst was inflation. Sometimes it was geopolitical uncertainty. Sometimes it was financial instability. But regardless of the cause, one asset has remained part of the conversation for generations. Gold. Not because it guarantees profits. Not because it always outperforms other investments. But because it serves a purpose that few financial assets can. Unlike government bonds, gold isn't another country's liability. Unlike paper currencies, it cannot be created with the stroke of a keyboard. Unlike equities, its value isn't dependent on corporate earnings or economic expansion. Its role has always been different. It represents financial resilience. Think of it like the emergency systems built into a modern aircraft. Passengers rarely think about them during a smooth flight. Pilots hope they'll never need them. But their presence provides confidence that unexpected events can be managed if conditions suddenly change. Gold has historically played a similar role within national reserves. Not because policymakers expect disaster tomorrow, but because responsible institutions prepare for possibilities before they become probabilities. Today's environment makes that philosophy increasingly relevant. Around the world, government debt remains historically elevated. Supply chains continue adapting to geopolitical shifts. Competition for critical resources is intensifying. Economic alliances are evolving, and nations are reassessing long-term financial resilience in ways that would have seemed unnecessary just a decade ago. None of these developments automatically signal a crisis. But together, they paint a picture of a world becoming more complex, more interconnected, and less predictable. Perhaps that's why experienced institutions aren't waiting for certainty before making long-term decisions. Because history suggests that by the time certainty finally arrives, the opportunity to prepare has often disappeared. The smartest investors understand a simple truth. Preparation begins long before headlines confirm it was the right decision. And that raises an even more important question. If central banks prepare years in advance, what lessons can ordinary investors learn from the greatest monetary transitions in modern history? Because history doesn't simply explain where we've been. It often reveals where we may be heading next. One of the biggest myths in investing is that major market moves begin with dramatic headlines. History suggests the opposite. They begin quietly, long before newspapers declare a new bull market, long before television analysts change their forecasts, long before the average investor believes anything significant has changed. The early signals are almost always dismissed as temporary. Consider the monetary transition of the early 1970s. When the United States ended the dollar's convertibility into gold in 1971, many believed the change would have only a limited impact. Few imagined they were witnessing the beginning of a completely new monetary era. Then inflation accelerated. Energy prices surged. Economic uncertainty spread across developed economies. And gold entered one of the most remarkable advances in modern financial history. It wasn't one announcement that changed everything. It was the gradual accumulation of pressures that had been building beneath the surface for years. The same pattern appeared before the global financial crisis. Throughout the early 2000s, credit expanded rapidly. Housing prices climbed year after year. Financial markets appeared healthy on the surface, while leverage quietly increased underneath. By the time confidence finally broke, the warning signs had existed for much longer than most people realized. Markets simply chose to ignore them. Even after the pandemic, history offered another reminder. Massive government spending, extraordinary monetary stimulus, disrupted supply chains, and labor shortages gradually combined to create inflation levels that many experts initially believed would be temporary. Again, the transformation wasn't immediate. It unfolded one decision, one policy, and one economic report at a time. That's how history usually works. The biggest changes don't happen in a single day. They build momentum slowly until the evidence becomes impossible to ignore. Today's environment contains several familiar ingredients. Persistent government debt. Changing geopolitical alliances. Questions surrounding long-term monetary stability. Central banks balancing inflation with economic growth. And investors searching for assets capable of preserving purchasing power during uncertain times. Does this guarantee another historic move in gold? Of course not. Financial markets have never operated on guarantees. But history teaches something far more valuable than predictions. It teaches patterns. And those patterns remind us that successful investors rarely wait until every headline agrees. They study long-term trends. They focus on structural change rather than daily volatility. Most importantly, they recognize that the greatest opportunities often appear long before the majority of the market believes anything has changed. Because by the time everyone agrees a new chapter has begun, the smartest money is already preparing for the chapter after that. Every generation of investors believes it has finally figured the market out. The technology boom convinced many people that traditional valuation no longer mattered. The housing boom created the belief that real estate prices could only move in one direction. More recently, periods of rapid stock market gains encouraged some investors to believe that diversification had become unnecessary because a handful of high-performing assets appeared capable of delivering extraordinary returns year after year. History has a way of humbling that kind of confidence. Not because innovation stops, not because growth disappears, but because markets have always moved in cycles, and every cycle eventually challenges the assumptions that seemed unquestionable only a few years earlier. Perhaps the greatest investing mistake isn't buying the wrong asset. It's believing the future can be predicted with certainty. Successful investors understand something that newcomers often learn the hard way. The future is uncertain by definition. No economist can perfectly forecast the next recession. No central banker can eliminate every financial risk. No analyst can consistently predict where every market will trade next year. That's why disciplined investors don't build portfolios around certainty. They build them around resilience. Think about the world's strongest buildings. Architects don't design skyscrapers assuming there will never be strong winds or earthquakes. Instead, they assume uncertainty is inevitable and engineer structures capable of absorbing unexpected stress. The same philosophy applies to investing. Resilient portfolios aren't designed to perform well under one perfect economic scenario. They're designed to remain strong across multiple possible futures. That distinction becomes especially important during periods like the one we are experiencing today. Inflation has eased from recent highs, yet the cost of living remains elevated compared with only a few years ago. Governments continue managing record debt levels. Interest rate expectations change almost monthly. Artificial intelligence is reshaping industries while geopolitical tensions continue influencing supply chains, energy markets, and global trade. No one knows which of these forces will dominate over the next decade. And that's precisely why preparation matters. Many experienced investors don't own gold because they expect economic collapse. They own it because history reminds them that unexpected events happen far more often than people expect. Sometimes those events involve inflation. Sometimes banking stress. Sometimes currency volatility. Sometimes geopolitical conflict. The specific trigger changes. The principle never does. Preparation has consistently proven more valuable than prediction. Perhaps that's also why central banks continue maintaining diversified reserve portfolios instead of relying on a single asset class. They understand that uncertainty isn't a temporary condition. It's a permanent feature of financial markets. And the investors who recognize that reality often make calmer, more disciplined decisions when volatility inevitably returns. But if preparation is more valuable than prediction, one final question remains. What does all of this mean for the next chapter in Gold's story? And more importantly, what does it mean for the investors trying to protect their financial future? As we bring together everything we've explored, one conclusion becomes increasingly difficult to ignore. This story has never been about whether gold reaches a particular price next month or next year. It's about recognizing that the financial environment surrounding gold is evolving. Quietly, gradually, almost invisibly. Throughout this documentary, we've examined several forces shaping today's global economy. Persistent government debt, changing monetary policy, long-term inflation concerns, shifting geopolitical relationships, the continued role of central banks in protecting financial stability. Individually, none of these developments guarantee a major change. Together, however, they create an environment where investors naturally begin thinking differently about risk, diversification, and long-term wealth preservation. History reminds us that markets rarely move because of a single headline. They move because expectations slowly begin changing beneath the surface. By the time those changing expectations become obvious, the largest institutions have often been adjusting their strategies for years. That doesn't mean they're always right. Even central banks and professional investors face uncertainty. But they understand an important principle. Preparation is a process, not an event. The same lesson applies to individual investors. Waiting for absolute certainty may feel comfortable, but certainty often arrives only after opportunities and risks have already become widely recognized. The goal isn't to predict every market movement. The goal is to understand the environment in which those movements occur. That's what separates reaction from preparation. economic growth, inflation, interest rates, currency strength, geopolitical developments, investor psychology. No single variable can determine its path, yet history consistently shows that during periods when confidence, monetary policy, and economic uncertainty intersect, gold tends to become part of a much broader conversation about preserving purchasing power and managing long-term financial risk. Perhaps that's the real message behind everything we've discussed today. The greatest investment opportunities rarely begin with certainty. They begin with awareness. Awareness that the world is changing. Awareness that financial systems continue evolving. An awareness that disciplined investors prepare long before the headlines tell everyone else to pay attention. Because when history eventually looks back on this period, the most important question may not be whether gold moved higher or lower. It may be whether investors recognized the quiet signals while there was still time to think clearly, act rationally, and prepare wisely. And that leads us to the final chapter of this documentary, where we step back from the charts, the headlines, and the daily market noise to answer one simple question. What is the single greatest lesson every investor should carry into the future, regardless of where gold goes next? If you've stayed with me until this point, you've probably realized something important. This documentary was never really about gold. Gold is simply the lens through which we've examined something much larger. A changing financial world. Throughout history, every generation has experienced a moment when old assumptions were challenged. There was a time when people believed currencies would always be backed by gold. That changed. There was a time when many believed inflation had become a problem of the past. That changed. There was a time when investors assumed globalization would continue expanding without interruption. That changed too. History moves forward. Markets adapt. And investors must adapt with them. The question isn't whether change is coming. The question is whether you'll recognize it while it's happening. One of the greatest misconceptions in investing is believing that successful investors always know exactly what comes next. In reality, the opposite is often true. The most successful investors openly admit they don't know the future. Instead, they focus on probabilities. They ask better questions. They prepare for multiple outcomes instead of becoming emotionally attached to one prediction. That's exactly why diversification has survived every financial era. It's about respecting uncertainty. Look at how the world's largest institutions operate. They don't place every reserve into a single currency. They don't concentrate every investment into one asset. They spread risk because they understand something fundamental. Unexpected events are inevitable. No matter how advanced financial models become, uncertainty never disappears. New technologies emerge. Political leadership changes. Wars begin. Economic cycles evolve. Inflation rises and falls. Interest rate policies shift. Every decade introduces a challenge that few people anticipated at the beginning of that decade. Perhaps the greatest investment advantage isn't intelligence. It's humility. The humility to admit that no one, not governments, not economists, not central bankers, not market analysts, can eliminate uncertainty. Once investors accept that reality, their entire mindset begins changing. Instead of asking, "How do I become rich overnight?" they begin asking, "How do I remain financially secure regardless of what happens?" That shift is transformational, because wealth preservation has always outlasted wealth speculation. This brings us back to gold. Whether you ultimately decide gold deserves a place in your portfolio isn't the central message of this documentary. The central message is understanding why serious institutions continue studying monetary history, monitoring inflation, analyzing government debt, and preparing for multiple economic outcomes. They're not preparing because they know exactly what tomorrow will look like. They're preparing because they know they don't. Perhaps that's the greatest lesson history offers every generation. Preparation has always been cheaper than regret. When people look back at previous financial transitions, they often ask, why didn't more people see it coming? The answer is surprisingly simple. Because the signals rarely arrive as dramatic headlines. They arrive as small changes that most people dismiss until years later. And maybe, just maybe, those quiet signals are beginning to appear once again. History never sends an invitation before it changes direction. It simply moves forward. Quietly. One policy decision at a time. One central bank meeting at a time. One shift in investor confidence at a time. Years later, people look back and call it a turning point. But those living through it rarely recognized it in real time. Perhaps that's where we are today. Not standing at the end of a story. Standing at the beginning of one. Whether gold ultimately becomes one of the defining assets of the next decade remains uncertain. Whether inflation completely disappears or returns with renewed strength remains uncertain. Whether governments successfully navigate rising debt, evolving monetary policy, and an increasingly complex global economy remains uncertain. But uncertainty has never been the enemy of successful investors. Ignoring it has. Because throughout every major monetary transition in modern history, one principle has consistently separated those who preserved wealth from those who reacted too late. They prepared before certainty existed, not after. And that principle may matter more over the next decade than at any point in recent history. If you found this documentary valuable, subscribe and join a community of investors who believe decisions should be guided by history, evidence, and long-term thinking, not hype or fear. Every week, we break down the biggest developments in gold, silver, central banking, inflation, macroeconomics, and global financial markets to help you see the bigger picture before it becomes tomorrow's headline. Now I want to hear your perspective. Do you believe gold's next major move has already begun, or is the market still waiting for its defining catalyst? Share your opinion in the comments below. I read them all, and some of the best discussions happen there. Until next time, stay informed, stay patient, protect your purchasing power, because markets reward information, but history rewards those who prepare before everyone else realizes why they should.